Great day, great day. I trust all is fantastic. Brian Arahan with another quick pro tip with a pro coach. And I'm having a lot of conversations with agents and some top teams. The discussion come up around what are some of the biggest objections today that we're experiencing in this market right now. And one of the main things that have come up, and you might be surprised to hear this, and maybe not, that about 70% of the objections out there that we're seeing with our big teams, individual agents in general, just across the marketplace, is around obviously interest rates, right? Payments. And, a lot of consumers really being concerned about the sticker price or the shock factor that come with higher interest rates and ultimately higher payments. And we had a great conversation with a great rainmaker of a team, and I think a great perspective to share whenever a client has this conversation with you is to walk them through the numbers, right? At the end of the day, this market right now currently is a show me market. It's not a tell me market. And such a lot of us may get into is just looking to just tell. And we know that that's not selling, right? And so we want to ask questions, we want to dig in, and we want to have this in general conversation. So imagine somebody brings that up when you have the conversation around, all right, well, what's stopping you from moving forward, right? 2023 is a great year. Have you considered buying a home this year? And somebody says, well, no, I'm thinking about holding off. And your response might be, well, what specifically is stopping you from getting a home, right? Your first property in this case. And somebody may say, well, it just seems really high, right? Prices are way up, and I'm hearing interest rates are, in that 6.3%. Oh, wow. Well, I appreciate you bringing that up. And, so from what I'm hearing you say, I'm always going to repeat that back, that you're actually holding off right now because you're feeling that you're currently feeling that right now the cost of a mortgage is higher, right, with a higher interest rate and ultimately higher payment. Is that what I'm hearing? Yeah, that's what I'm hearing. Well, okay. Well, thank you, number one, for bringing that up and allowing me to understand really what the challenge is there for you. And yet, can I share with you why you might be leaving some money or opportunity on the table? What do you mean? Well, as an agent, right, I have these conversations a lot, and one thing that I see is that we typically step over dollars to pick up cents. Well, what do you mean? Well, here's the thing. What if I could show you the numbers behind what I mean when I say that? Okay, so now as an agent, I'm either gonna have them walk through with this over the phone, or ideally on Zoom, or send them a quick video. And it's important that they go through these numbers with you, and they see it and also calculate it. And so where I'm going to pick up is I'm going to say, hey, well, Mr. and Mrs. Client, what is your ideal purchase price, right? Where do you feel the home that you've been looking at or watching would cost you as far as a price goes? Well, 700,000. Okay, well, great. 700,000 is your ideal property, and with that, you're going to get the bedroom count, the location, the square footage, the lot that you're looking for. Is that about right? Yeah, perfect. Great. Thank you for bringing that up. So then now let's go ahead and look at that. Now, based off of that $700,000 property, out of curiosity, what would be the interest rate that you would be comfortable paying on a $700,000 mortgage? Now, they may be used to the 3%, three and a quarter, 3.5. It doesn't really matter when it's all said and done. Let's just say maybe somebody's semi-realistic and they say, well, 4% sounds good to me. Okay, well, great. Let's go ahead and break that down. And so I'm going to, in this case, share my screen, or if I have the ability to do that over Zoom is always a great practice, or have them personally just go ahead and go to a mortgage calculator that you can find online anywhere. And so I'm going to have them really dive into this number. So I went ahead and pre-populated $700,000 is what they're considering the purchase for. Let's just say they're doing 10% down. That's going to be a loan amount of 630,000. And I put in 6.5% interest rate is what they could currently qualify for, right? And so let's go 6.5, loan term 30 years, etc. So based off of that, we get a mortgage payment, principal, interest, taxes, and insurance of about 4790. I'm sorry, principal, interest, and mortgage, right? So basically, actually everything, right? So with that, they're looking at $4,790 is what they're going to be expecting, or roughly, right, approximate a mortgage payment on a $700,000 purchase. Now, let's go back to, and we're going to go and write that number down and make sure that they see that and are aware of that. So when you look at that, 4,790. Now we're going to go back and say, okay, well, you were considering a mortgage payment of 4%, correct? All right, great. So now your mortgage payment of 4% is going to cost you roughly, if you got that mortgage at 4%, you'd be at $3,816 roughly every single month. Okay, so now this is where I'm going to break out my calculator, and we're going to look at some math here, and we're just going to do 4,790, right, minus or what their ideal payment would be at 4%, right? And so we're going to look at the 6.5% interest payment difference with the 4% interest payment. And what they would get is, okay, so basically we're talking about a $974 difference annually. I'm sorry, every month. So every single month we're looking at a $974 difference. Now let's go ahead and look at that difference over the course of the year. So Mr. and Mrs. Client, we're really talking about on an annual basis. That's an $11,688 difference, and I could see how that'd be important to you, right? Your budget may be upset if you went with that 6.5% interest. Now, may I share with you what the opportunities are? Okay, well, yeah, please do that. So now, based off of what we're seeing in general, now we're in Southern California, we see appreciation, and your markets, depending on where you are, may have that luxury and may not. And yet, I'm always going to go back to, let's look at history, Mr. and Mrs. Client. In history, what we know is that, and there's some really good articles, and we look at Neighborhood Scout here, and yet we know based off of history in all of California anyway, that over the last 10 years, the average appreciation has been 8.43%. Now, if we look at over the last 20 years, which includes a Great Recession, includes actually multiple recessions, if you count the very beginning of that 2000 .com bubble, if you will, that also factors in. So over the last 20 years, 2 decades, the average appreciation, factor in a global meltdown, et cetera, was 5.58%. Let's go ahead and write that down. Right, 5.58%. So, and I would show them this. So, Mr. and Mrs. Client, it'd be fair to say that your value, the property that you own at $700,000, you can expect to go up roughly about 5.58%. Are you okay with that? With us using those numbers? All right, great. And let's just say, you know what, I'm okay with us using just 5%. So, what I'm going to do here is I'm going to go to this other system that we've got here, a great website, and I can share these links with you. And yet these sites gives us the opportunity to magnify what that appreciation looks like over the course of however many years. So in this case, let's just say, Mr. and Mrs. Client, this $700,000 home in 1 year is going to appreciate, right, almost $40,000. So when we look at $40,000 appreciation on your home there, let's just say on $40,000, right? So now we're going to look at the difference between that 11,688. So first we're going to do, so you purchased this at 700,000, and you're going to look at the home now is worth 740 to 50. So then now we're looking at a $40,000 and $40,250 increase on an annual basis there, right? So then now, Mr. and Mrs. Seller, so if we're looking at that $40,250 minus what your increase in monthly payment would be, you're looking at a difference of roughly $28,000 positive that you would be not factoring in debt pay down of your mortgage, also not factoring in any tax deductions based off of you holding real estate. And so, Mr. and Mrs. Client, you have a net gain of about $28,562, assuming that you have the ability to work your budget around that higher payment at 6.5%. Going back to this chart here. So assuming that, Mr. and Mrs. Client, you're okay and you're able to, again, I'm not going to have anybody buy a home that they can't afford, they can't comfortably pay on an every single month basis. And if you're looking at a $4,790 payment, Mr. and Mrs. Client, can you afford that? Yes. Can you afford that over the course of the next 12 months and beyond? Yes. Okay. Well, let's go ahead and look at the numbers going back here. Again, your average appreciation, if we're just using, let's even just go with that 5.75%. Let's go ahead and go to, all right, what's your net gain over the next 3 years if you'll own the home for the next 3 years? Look, your property ends up becoming worth about $827,000 in the next 3 years. Let's look at 5 years. Let's go ahead and look at 10 years out, what that property is valued at. So just by buying a property today and owning it for the next 10 years, is it very likely in the next 10 years that home is in that over $1 million range? It's very likely. So, Mr. and Mrs. Client, would you really like to not own a home, probably pay higher taxes, have rent continue to go up if you don't own a property, and pass up on annual appreciation that you can use later on to create additional opportunity for yourself in the future with equity built up over time? So when we look at these numbers here, but by the way, if anybody that's looking or considering to buy a home, basically buy a property and sell a property, or sell then buy, then the numbers work just the same. And that's really us looking at the difference between what they currently own and what they're looking to buy. Typically, when people move up, they move up to a higher price point when they buy larger homes, bigger square footage, overall bigger property. And why you have some people maybe holding off and saying, well, I don't want to go to that bigger home right now. Well, here's the thing. Would you rather have a 5.75 or 5.5% appreciation on say a $500,000 home, or would you like to have that 5% appreciation on a $700,000 home or beyond? Which one works best for you? So this is a great way to show a visual, have them do the exercise, run the calculations on a mortgage calculator, show them the average appreciation, and look at the net gain on an annual basis. So that way they're seeing, hey, well, if I just stay where I'm at, I might be missing out on added appreciation and all the resources that gives me in the future of from owning property, tax deductions, debt pay down, and all the other great things that come with owning your own property. So with that being said, let's go ahead and use it. Let's make those presentations. Let's have those conversations that are going to help people create clarity on why right now is a great time to still act and take advantage of the real estate market. Be well.